How is everybody doing? Welcome to the Strategy Room this Saturday night, December 21st, 2024. I am your host, Dr. Joe Berquist, on this basically Christmas edition of the Strategy Room. But I hope everybody is buckled in for tonight because I got a lot of stuff to bring you. And I'm in a little bit of a mood tonight. I've got a lot of things here we're going to dig into, and you'll understand my mood by the time we get to the end of the evening. You will understand. So let's dive into a couple things here real quick. So first of all, obviously I should start with last night. Obviously the Senate and the Congress got together last night, passed the continuing resolution. So thankfully we didn't get any major shutdown or any other problems, and so that got passed into early next year, probably around March timeframe. So that definitely helps with some of the troubles, if you will, of kind of sorting through the mess, as it were. But then, the other big news earlier in the week was the Federal Reserve decided to cut interest rates by another quarter percentage points, bringing the total cuts to 100 basis points, or 1%, that the Fed has brought down over the last 4 months and through their last 3 meetings. Now, what I have up here on the screen is basically the Federal Reserve's statement. Before I get to that, I just want to read another piece here that basically says, as expected, the Fed lowered the benchmark rate by 25 basis points to a target range of 4.25 to 4.5%. Now, that is the federal funds rate, making the third rate cut in over 4 years. The Fed's updated economic projections now show a 50 basis point rate cut in 2025 to 3.9% from 3.4% in September. Additionally, the median forecast for PCE inflation increased to 2.5% from 2.1%, and core PCE inflation forecast rose to 2.8% from 2.6%. The Fed also lowered the overnight reverse repo rate to 4.25 from 4.44%. Now, the market's reaction: the release was viewed as hawkish. The S&P 500, the United States Treasury, the 2-year, and the United States 10 years were mostly unchanged. Not true. They actually went up. We'll go over that in just a second. Currently, the market is pricing a 97% likelihood that the Fed funds target at the January 29, 2025 meeting will remain the same. In other words, no cut. The FOMC announced the following actions and analysis. The FOMC, the votes were 11-1, so it was not unanimous. To lower the benchmark rate, the Cleveland Fed President Hammack was the only dissenting vote, which is interesting because we have seen a couple of dissenting votes in the last few months, which we do not normally see that. Normally it's unanimous. Normally it's 12-0. So that's a little bit different. The unemployment rate has remained low and inflation remains elevated. However, the Fed will continue to be data dependent in deciding future moves. The Fed will reduce the rate it pays lenders using the overnight reverse repurchase facility by 30 basis points. The Fed cut the Treasury runoff cap to $25 billion from $60 billion. So the Fed's still reducing their balance sheet a little bit there, as it were. So now, before I go on, let's jump into this Fed statement for a second. Let's see what it says here. So, and this is not long. So, recent indicators suggest that economic activity has continued to expand at a solid pace. Really? Since earlier in the year, labor market conditions have generally eased or gotten horribly worse. Depends on who you ask. And the unemployment rate has moved up but remains low. Inflation has made progress toward the committee's 2% objective. It's never gotten near 2%, and it's settled in way above 2%. And they acknowledge that by basically saying that they raised all of their inflation expectations, PCE to 2.5%. The core PCE up to 2.8%. That's nowhere near 2%. So they've already basically admitted defeat there, and that they're not going to be able to get it back down to 2%. The committee seeks to achieve a maximum employment inflation at the rate of 2% over the long run. Yeah, not doing good in either of those, to their dual mandate, if you will. The committee judges that the risks to achieving its employment and inflation goals are roughly in balance. I really want to know who writes this stuff. The economic outlook is uncertain, and the committee is attentive to the risks to both sides of its dual mandate. So you got to love how they write that. On the one side, they're saying that, hey, everything is good, everything's in balance, we're good. But then they always hedge the bet by saying the economic outlook is uncertain. Really? Because you just said it was balanced a second ago. In support of its goals, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 4 1/4 to 4.5%. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. So there you have it, ladies and gentlemen. The Fed is going to continue to just roll somewhat as normal. Now, here's the big question. What about rates for next year? As we saw this week, the market took a massive just dump, if you will. It was down 1,100 points on Wednesday after this announcement. So why did the market react like that? Well, the market had already priced in that the Fed was going to be very aggressive with rate cuts next year. Well, the Fed basically signaled that now instead of getting another 150 basis points of rate cuts, you are only going to get 50, maybe get 50 basis points. I think there's a very good chance, depending on what inflation does, that they're not going to reduce the rates. There's something else to consider here. There is now a giant, I think, politics once again are rearing their ugly head in the Fed. You've heard a lot of news the last couple of weeks about, is Jeremy Powell going to kind of fight with Donald Trump? Is Trump going to insist on certain, policy? Are they going to insist that interest rates get cut and get reduced? So that's a big thing now. Are Trump and Powell going to start, butting heads? Is Powell going to do certain things in an attempt to basically give Trump and his administration the shaft? I think that is a very legitimate question. Is Powell going to basically try to now sink the Trump administration, basically the economy be darned, and basically to heck with the American people? He's going to, just to kind of stick it to Trump, if you will, he's going to sink this economy. I think that's a very fair question to ask. I think it's a very, very fair question to ask. And I think that, Jeremy Powell is going to be in unique standing here in a very short period of time, because all of the people, his buddy, his good friend, Janet Yellen, and we'll get to her in a minute. She's going to be out of there in just a few short weeks. She's going to be gone. His buddies at the FBI and the DOJ, they're going to be gone. He's going to be, in a certain respects, he's going to be like the last of the Mohicans, sitting over there, all by his lonesome. And, the question becomes, does he get, kind of egged on by people in DC, if you will, to basically say, oh, you're our last hope. You're our last hope. We need you. We need you to basically, stick it to Trump. Don't let him get a win here. Don't let him re-energize the economy. Don't let him get things going. Don't cut the rates. But here's the problem. There are a couple of very big things here. If he decides, first of all, the labor market has severely deteriorated. And those numbers on the labor market have been all BS all year long. And those numbers are going to dramatically change here in the next couple of months. We're going to get massive revisions in January and February from the Bureau of Labor Statistics. Some of the different Philly Fed numbers, some of the other numbers are going to start to come out on the labor market. Is going to paint a very different picture of where the labor market actually is. The unemployment rate is going to jump up. It's going to go back up over 5%. That's going to put a lot of pressure on the Fed to do something. Will the Fed change their stance? Their stance to this point has basically been, hey, everything with inflation's great. We're bringing it back down. It's coming closer to 2%. Even though it's been inching upward the last 3-4 months, it's been inching back upward. But will they lean on that crutch? Will they pull that argument out of the hat, so to speak, and say, hey, we're really kind of concerned about inflation here because it's kind of settled in closer to 3%, and we need it to be down at 2%. So we really don't want to cut the rates because we don't want we're worried about inflation spiking back up. So that's a question. Will they do that? The other big thing is on the national debt. Obviously, it costs the government a huge amount of money just in interest alone to service the national debt. There's a lot of people in the government, the president included, that will basically say, hey, Mr. Powell, we need you to bring the interest rates down because we need you to make servicing the national debt cheaper, because that's going to help us on the fiscal side of the equation. That's going to help us with our fiscal policy. You handle monetary policy, we need to handle fiscal policy. And our fiscal policy would really be aided if you would reduce the rates. So, how does Jeremy? So if we have this national debt crisis, which Jeremy Powell has already admitted needs to be addressed, that it can't just be left out there. He even said in the 60 Minutes interview not too long ago that, yes, the national debt is a major problem. Janet Yellen said this week unbelievably in her kind of closing remarks, that she's, national debt is a big problem and we need to address it. So if national debt's a major problem, if the labor market continues to massively deteriorate, and if inflation is not going hog wild, if it's just kind of hanging out around 2.5% to 3%, what's Powell's rationale then for not reducing rates further? Then you have the third issue, and that is banks. Banking right now. I want to show you guys something here. Where is it? Debt. No. I'm going to find it here. Give me a second. This is now. Hang on. Where is it? Come on. Here it is. Underwater bond hurdle to M&A remains despite third quarter improvement. So here you go. Unrealized losses in banks' bond portfolios still massively in the red. Still way down. So banks have two big problems. They have this in the bond in their investment portfolio. They have unrealized losses on bonds in their portfolio. Still have massive hits that they can take. That's number one. Number two is on loans, both on the asset side of the balance sheet. Their investments and loans, two biggest assets that banks have. On the loan side, you have this thing called the maturity wall has been created for the last, couple of years because banks have been doing this thing called extend and pretend, and they've been pushing out the renewal of a lot of loans. They have to roll over debt every so many years, especially on a lot of their fixed rate debt, commercial mortgages, term loans, equipment loans, all this kind of stuff. They haven't been rolling that debt over because they've been hoping that the Federal Reserve is going to bring interest rates down and bring them down a lot. They brought them down 100 basis points. That's great. But they really needed them to bring them down 200, 250, 300 basis points. That's what they needed. That's what they needed the Fed to do. Now it's maybe not looking so much like the Fed is going to do that. So they're going to hit this maturity wall. This is going to lead to a tremendous amount of delinquency and charge-offs for a lot of banks around the country, particularly a lot of the regional banks. So those are the three big issues facing Powell if he doesn't want to continue reducing rates. If he doesn't want to reduce rates, you've got the employment market is going to tank. It's going to continue to be extremely expensive for the government to continue to service the national debt. And you've got the problem with banks right there. Those are three major reasons for him to continue cutting interest rates. The one big issue he has to not continue increasing interest or decreasing interest rates is inflation. And that's a big one. That's a big one, because that one by itself could outrule the other one. And all we can do there is continue to look at the economic numbers. Now, but here's the thing. How do you defeat inflation? You defeat inflation. I'm going to come up to this article here in a second. You defeat inflation by reducing spending. It's government spending that causes inflation. Boom. End of story. That's it. Government spending causes inflation. So how do you defeat inflation? Well, you can increase interest rates way up, or wait for it, you can dramatically reduce government spending. There's this thing that we have right now called a massive $2 trillion deficit. Well, if you reduce the deficit by $2 trillion and you bring it back to a balanced budget, what is that going to do? Well, that's going to dramatically help with inflation. So if we can get massive cuts, in there, and we can try to work back toward a balanced budget, that will dramatically help with the inflation equation. And that will give Powell more, ammunition, so to speak, to reduce interest rates. But what did we just see? I just said 16 minutes ago when I started here, I said that we averted the government shutdown, that they passed the CR. But what was the big fight over? What was that big fight over? The big fight was over spending. They had, again, the boys in Congress threw in a whole, they had some good stuff there. We had to get the farm bill done. We had to get money to the people in North Carolina and Georgia and Florida that got hit with the hurricanes. That was all, the cancer, what was the other one? The cancer research for kids, whatever, that was all great stuff. We had to have that in there. You had to have it out. But there was an insane, stupid amount of pork spending in there as well. And the problem that I have been saying for basically the whole year is that there is no appetite. We're going to find out. Everybody's going to find out here in just a few short months. There is no appetite on either side of the aisle, Republican or Democrat, to reduce spending. Zero, none. These guys want to want to have their cake and eat it too. They want to give themselves pay raises, and they want to just spend our money into oblivion. And that has got to be checked. It's got to be stopped. Otherwise, if we can't have massive cuts to government spending, this is all going to continue to unravel, and it will. As Mark Twain famously said, how did you go broke? Slowly, and then all at once. And that's how we're going broke right now. Very slowly, but then it will happen all at once, and it will unravel whenever it hits that point. It will unravel very quickly. So like I said, we're going to see here what's going on now. We're going to see here in the next couple of months what Jeremy Powell is going to do with this whole thing. So just a couple articles here on this. So basically, the Fed cuts by a quarter point indicates fewer reductions ahead. Today was a closer call, but we decided it was the right call, said Jeremy Powell. The Fed indicates that it probably would only lower twice more in 2025, according to the closely watched dot plot matrix of individual members' future rate expectations. There's the rate cut. I think, did it have a dot plot in here? No, I guess not. I thought it might have had a dot plot actually in this article here, but yeah. So then we go on here. So the Fed sees only 2 rate cuts in 2025, fewer than previously projected. That's why the market was, basically very taken off guard by this whole thing. The so-called dot plot, which indicates individual members' expectations for rates, showed officials see their benchmark lending rate falling to 3.9% by the end of 2025, equivalent to a target range of 3.75 to 4%. The Fed had previously projected 4 quarter-point cuts or a full percentage point reduction in 2025 at a meeting in September. Like I said, they were looking for another. Wall Street was even looking for more than that. I'd say they were looking for more like 150 basis. 1.5% rate cut is what they were really looking for. So yeah, here's our dot plot here. So we have our dot plots here. You can see kind of changing here for 2025 here at the bottom, and we got 26, 27 and longer run. But yeah, the majority here basically seeing us somewhere in the neighborhood of 3.75 to 4%. A little bit more balanced going into 2025 at this point. Not too many people seeing cuts below 3% basically. So see that. And then we'll go on. So the Fed's rate outlook has rattled markets. Here's what it means for global central banks. So the U.S. Federal Reserve roiled markets Wednesday after raising its inflation outlook and signaling fewer rate cuts next year. Stronger U.S. dollar on the back of higher interest rates and potentially inflationary tariffs from President-elect Donald Trump make the outlook for policy easing around the world more uncertain. I love the tariff thing. The mainstream media, from the people who brought you transitory inflation, mild inflation doesn't matter, from the people who brought you modern monetary theory that basically you can just print money into oblivion, from all these geniuses out there. I love the whole tariff argument. Okay. Tariffs are a negotiating tool. It's leverage. Yes, will we see a few tariffs? Probably some tariffs on China, maybe a tariff on Canada. I think just for the laughs of it. But this idea that the mainstream media promotes, that there's just that Trump's going to come out, he's going to come gangbusters day one, and he's just going to put tariffs on anybody and everybody across the board, and it's going to drive massive inflation. It's ridiculous. That's not what's going to happen. He's, like I said, 99% of the time he's going to use the tariffs as a negotiation tool, and it is the best tool that he has in his toolbox. I think that the majority of our presidents, particularly over the last probably 70, 80 years, have been morons for not using the tariffs. If I was president, I would use the tariffs. I would threaten people with tariffs every day. I'd be out there. You don't do what I want, I'll hit you with the tariff, because that means something. It means something to them. They know, for like Mexico, for Canada, for these guys know if they get hit with tariffs, it's going to hurt us. It's going to destroy them. It will destroy their economy. And they cannot have that, because they will not stay in power. They will not get reelected if they tank their economies. So they will come to the table and they will play ball at the end of the day. So why you wouldn't use that as a negotiating tactic, I have no idea. But again, like I said, this whole narrative around tariffs is just completely ridiculous and overblown. But anyway, I digress. Let's get back to this for a second. So while global central banks insist their monetary policy decisions are made independently of the Fed, currency moves could force them to act. Yes, I do. So the U.S. Federal Reserve, though global central banks insist on independence in their monetary policy decisions. Here's their independence. What did the Fed do? Okay, now we're gonna move. A stronger U.S. dollar on the back of higher interest rates and potentially inflationary tariffs from President Trump make the outlook for policy easing around the world more uncertain. When you have a more hawkish Fed, this will lead to a stronger U.S. dollar and a tightening of global financial conditions. Quan Wang, chief Asian Pacific economist at Vanguard, said, this is especially true in a lot of emerging markets, she added. I do think central banks in Asia are generally moving towards easing, but given this Fed is going to stay higher for longer, there will be less room for easing. Really? Because, China's market is basically about to implode because they have the largest real estate bubble in the history of the world. Japan is hanging on by a thread. So, I think easing is almost guaranteed in those economies. CNBC takes a look at what's in store. So then it goes through like Asia. The Fed's cautious stance on future rate cuts sends most Asian currencies reeling Thursday. Yeah, because they got this whole thing called the carry trade, which I've talked about in previous episodes. It's a big problem for them. And then they have Bank of Japan, the People's Bank of China, like I said, Reserve Bank of India, Bank of Korea, Europe. One of my favorite people there, Christine Lagarde. She's a real piece of work. European Central Bank, Swiss National Bank, Bank of England. So we'll have more on that kind of now. I will say this: European banks for the better part of this year, European banks around the world have basically been making a lot of rate cuts. They've been dramatically reducing rates. We'll see if that trend continues. Will they continue to do that if the Fed is being more hawkish, if you will? So we shall see. But what happened with interest rates after the Fed cut this week? So 10-year Treasury yield leaps to 4.5% as Fed signals caution on future rate cuts. So the U.S. Treasury yield jumped on Wednesday after the Federal Reserve announced its latest interest rate cut, but signaled fewer could be on the horizon. The yield on the 10-year Treasury climbed nearly 12 basis points to 4.504% and has hovered around the key 4.5% level in afternoon trading. The 2-year Treasury yield surged more than 10 basis points to 4.348%. Yields and prices have an inverted relationship. 1 basis point is equivalent to 0.01%. So again, this pattern that we have seen over the last 4 months, as the Fed has cut rates, the treasuries have jumped. Somebody might have told you that was going to happen a few months ago. I don't know who, but somebody might have mentioned something about that. But here we go. Now we have the 10-year Treasury jumping to 4.5%. Now I would mention something here about the yield curve. I've talked, extensively in a few episodes about the yield curve, how the yield curve was inverted, and then it's kind of reverted back to positive territory, meaning that the 10-year was now higher than the 2-year. And so that's basically what we have here. 10 years at 4.53, 2 years at 4.319. But I also said technically the yield curve had not yet reverted because the 10-year was still lower than the 6-month and the 3-month and the 1 month. But what has happened here in the last, week and a half? The yield curve has officially, totally and completely reverted back to normal territory. We will now get what's called, from an inverted yield curve, we will now begin to get a steepening yield curve as the yield curve rises because long-term rates are going up higher than short-term rates. In other words, this is what a normal yield curve, sloping yield curve looks like. But that's a bad thing for a couple of reasons. Number one, first and foremost, what does that mean? That means that mortgage rates are not going to be coming down anytime soon. That means everybody's looking, mortgage rates back up to 7% here. Anybody out there thinking that mortgage rates were going to come back down to say, 4.5%, 5%, 5.5%. Yeah, that's basically out of the question. We are stuck, at least in the short term. I think for at least the next 6 months, I think the best thing that you can hope to see is maybe something in the 6s, maybe 6.5, 6.6, 6.7, something like that. But that's probably going to be about the best rate that you're going to get here in the next 6 months. I think, unfortunately now rates are stuck. And then you have to ask the question, well, what does that mean for the real estate industries, particularly with residential housing? Well, we'll kind of look at that in a few minutes. I got a couple articles on that probably closer toward the end tonight. But I just wanted you to point out here that now, look, the 1-month Treasury, 4.311, 3-month Treasury, 4.33, 6-month Treasury, 4.299, 1-year Treasury, 4.266. So this is the 10-year Treasury is now above at 4.53. The 10-year Treasury is now above all of the short-term rates, and it's above the 2-year rate. So that means it is officially now reverted back to a normal yield curve. This is now where we're at. And I said a few weeks ago, watch out if the 10-year Treasury goes over 4.5. It's now at 4.53. That could signal actually a continued run higher. Now, again, I want to reiterate to everybody, why is this happening? Why is the Treasury rates going up? It has to do with our national debt. You have to understand what Janet Yellen was doing over at the Treasury over the last year. She was putting everything into short-term bonds because basically Japan and China, the two biggest buyers of our national debt, particularly long-term national debt, had checked out. Not only were they not buying, they were actually selling their long-term bond holdings. Because why? Part of it was, like in China's case, they needed the money. In Japan's case, they were worried about the riskiness of our debt. Would we end up defaulting on our debt? The D word, would we end up defaulting on our debt? So now we have basically $1 trillion in short-term debt this year that is going to have to get rolled over into long-term debt. Well, in order for that to get rolled over successfully, what are investors going to want to entice them to come and start buying more? They're going to want to see higher rates. It's just your simple economics, risk and reward. The more risk that you're taking, the higher the reward you want to get. So our national debt it's going to continue to cause us massive problems because you issue the debt, but then you have to finance it. It's not just the government, Congress just strokes a pen and says we're going to spend this money. Then we have to go through the whole monetary policy, the whole monetary process of actually funding that debt. We then have to, then they got to go out, they got to fund the debt, then they got to do treasury auctions. And then somebody's got to buy the debt. A lot of it gets bought by the Fed, but a lot of it also gets bought by international investors. And, so that's a problem. And you have to roll that debt. So the long-term debt, as we just continue to roll more and more of it, it's going to get more expensive, meaning that longer-term yield curve rates, 10-year, 30-year, 15-year, they're just going to continue to go up. It's going to drive our rates up. So there is another argument to be made about the Fed. In other words, if the 10-year Treasury is, and you have to understand, key thing to understand about the 10-year Treasury, the 10-year Treasury drives everything in your life. It drives credit card rates. It drives auto rates. It drives your 30-year home mortgage rate. It drives student loan debt. It drives everything on the person. It drives a little bit on the commercial side, but on the residential side, it drives everything. Everything in your life is tied to that 10-year Treasury. So if the 10-year Treasury is going up and the Federal Reserve is reducing rates and the 10-year Treasury is continuing to go up while they're reducing rates, it begs the question, why are you reducing rates? If the effect of your rate cuts are completely nullified because the 10-year Treasury is going up, then why are you continuing to do it? So I think that's a very, that's a legitimate question to ask. But as I've said before, Mr. Bessent, Scott Bessent, who is going to be the new Treasury Secretary here in just, a month, I don't envy him. I don't envy his position. I don't envy his job. He has got a massive, colossal mess coming his way that is just, it's going to be very, very difficult for him to tackle that. Now, all right, let's talk about inflation here for a minute before I want to get to Janet Yellen's final comments this week. So let's talk about inflation here for a second. So we had a key metric that came out yesterday, the PCE, the price index. This is also known as the Fed's preferred inflation index. So the Fed key inflation measure shows 2.4% rate in November, lower than expected. So the PCE price index, the Fed's preferred inflation gauge, showed an increase of just 0.1% from October and a 2.4% annual rate, both below expectations. Excluding food and energy, core PCE also increased 0.1% monthly and was 2.8% higher from a year ago. Let me say that. I see that right. Excluding food and energy, the core PCE also increased 0.1% monthly and was 2.5% higher from a year ago. Does that sound like it's going down? With both readings being 0.1 percentage point below the forecast. I love this, the forecast. It keeps going up, but hey, it's below forecast, so it's cool. No, it's not. Personal income rose 0.3%, short of the 0.4% estimate. Personal expenditures increased 0.4%. So you notice that expenditures up higher than is rising faster than your income. 0.1 of a percentage point below the forecast. So prices barely moved in November, but still held higher than the Federal Reserve's target when looked at from a year ago, according to a Commerce Department measure released on Friday. And then let's look at the Fed's favorite measure of inflation was surprisingly tame in November. Really? Inflation was unexpectedly cool in November as measured by personal consumption expenditure. See, I love the headlines. See, the headlines are so misleading. Oh, well, their favorite measure of inflation was tame. I love the language. Surprisingly, not just tame, surprisingly tame. They don't want to mention the fact that inflation can continue to notch up each of the last 5 months. They just, it's like, and it's well above the Fed's 2% target on inflation. And it's settling now. You're seeing it settle in at that 2.5% to 3% range when you look at CPI, PPI, and now the PCE. When you have to kind of consider all three together at the same time. Officials at the Federal Reserve would likely need to see more good inflation reports in the coming months before making any further cuts to the high borrowing costs meant to keep inflation under control. And wait for it, inflation reaccelerated in November. Is that what the headline just said? Reaccelerated in November by the measure preferred by Central Reserve policymakers, but not as much as forecasters had expected. I love how they write this crap. It's ridiculous. And instead of just saying, you know what, inflation continues to be a nuisance, it continues to be a problem. It ticked a little higher here. It's a little concerning because it's risen a little bit more each month for the last 4 or 5 months. No, they don't say that. They say this nonsense. It was surprisingly tame in November. Like come on, man, really? Like, cut us a break. Okay, so but obviously at the end of the day, the issue here is that we're going to continue to monitor the inflation data, see what happens, and see where we go from there. And then here's an interesting article that was in the Wall Street Journal this week that was called "Inflation is Stuck. Can Trump Unstick It?" Trump has promised to tame prices, but even a president can only do so much. So inflation played a starring role in last month's election, and part of Donald Trump's pitch was that he would cool things off. I won on groceries, the president-elect said in an interview Sunday on Meet the Press in his nomination acceptance speech at the Republican National Convention in July. Trump said he would end the devastating inflation crisis immediately. Despite his pledge to lower inflation, if Trump follows through on some of his tariff and immigration, there's the tariff thing again, see? Tariff and immigration plan, economists worry he might do just the opposite. The pace of inflation has significantly cooled before the election, but anger hasn't subsided and costs are far higher than they were before the pandemic. On Wednesday, new inflation numbers suggested that progress on driving down rising costs had stalled. Oh, wait for it, had stalled. Is that the headline we just got? That inflation, that costs had gone down, right? Well, prices for groceries, for example, were up 1.6% from a year earlier in November, but they were up 27% from February of 2020. Overall, consumer prices were up 2.7% in November from a year earlier, a far cry from the 9.1% notched in 2022, but still a tad higher than the month before. Still a tad higher. New data Thursday showed that a month-over-month change in producer prices was more than economists had expected. Really? Again, is that the headline we just got? I thought it was below expectations, right? Any rise, even a small one, comes on top of already high prices, vexing Americans. So what can Trump do? Problem presidents face with inflation is that there is only so much they can really do to cool it off. Bringing overall prices down would be even harder and unwelcome. Really? Why is that? Falling prices or deflation would make it harder for borrowers to repay their loans, stifling the economy. Many of the measures that economists might prescribe to reduce inflation, such as increasing innovation, reducing regulatory burdens, or boosting the U.S. workforce's skills, would take years, if not decades, to bear fruit. I would argue that is complete BS. You saw in Trump's first term, you saw what he did in the first 3 years. He cut taxes. He dramatically reduced regulatory burdens. And what happened? The economy boomed. By the second half of 2018, all through 2019, the economy boomed. And it didn't get hurt until the pandemic hit. And then even toward the end of the pandemic, the economy started to open back up again. Things started to get a little bit better there toward the end of 2020. So the formula works. We know the formula works. We've seen it many times. President Reagan did the same formula. In a certain respect, President Clinton followed. He didn't cut taxes, but he reduced regulation. And so in a certain respect for President Clinton, this formula worked. So here's the formula: you reduce government spending, massive cut to spending. You dramatically reduce the regulatory burden. You increase innovation. What is Trump talked about doing? He's talked about, kind of opening up the crypto markets, doing more work with AI, chip manufacturing, all this innovation that we're all talking about constantly, day in and day out, week in and week out. And I'm not saying that'll kick in a day, a week, a month, or even a year, but I think you give him 2-3 years of working on this thing, and you're going to see this. You're going to see this come to fruition. Again, apart from us getting mired in World War III, which I pray every day does not happen. I think a lot of this stuff will come to fruition. We've seen the formula, and the formula works. And it's not one thing, it's a combination of things happening all at the same time. But if we can make that happen, we will see the fruits of those effects. But again, they go back to like, oh, well, his hands are tied. He can only do so much. And he wants to put all these tariffs out there, and it's not really going to work. The effectiveness of past presidential efforts to control inflation has been mixed. Inflation cooled in response to Richard Nixon's price controls, and then burst higher when those controls were removed. Yeah, the price controls was a stupid thing, and they didn't work. Gerald Ford's whip Inflation Now campaign was widely derided. Yeah, because it was stupid. Jimmy Carter was one of the Jimmy Carter was not a good president. He was not a good president. His foreign policy was atrocious, but his economic policy here at home wasn't much better either. There are also plenty of things outside the president's direct control that can raise prices. Think supply chain disruptions, natural disasters, far off wars, or Fed policy mistakes. So yeah, I would say at the last two things there, the wars and the Fed policy mistakes, like I said earlier, what's Jeremy Powell going to do here? Is Jeremy Powell going to try to shaft Trump just to be spiteful? And I've said that's a legitimate question to ask at this point. Will certain people in DC, like I said, Jeremy Powell is going to be kind of like the last man standing, if you will. Are certain forces in DC going to kind of egg him on to basically say, hey, we need you to go at Trump. We need you to cause a fight here. We need you to do something. Don't do what he wants you to do. Don't give in. Are we going to see that kind of situation unfold? We'll see. Time will tell. I don't know, but I do agree with those last two statements there that World War III, Jeremy Powell causing problems there at the Fed. Like, yeah, those two can have a dramatic impact on what Trump can do and how much he can get things done. Consider Trump's promise to reduce energy costs through faster permitting and weaker environmental regulations to drill, baby, drill. Trump's oil and natural gas supporters love his anti-regulatory bent, but they don't actually seem as eager to drill more. A fossil fuel glut during Trump's first term caused debt strains for many drillers, leading them to focus more on returning capital to shareholders than investing in new production. We'll see. I'm gonna be willing to bet that they're gonna open it back up, and they're gonna drill, and I think that he's going to entice them to do that. U.S. productivity growth, and then let's see down here, and it kind of goes into immigration restrictions. I kind of find it interesting. One thing about the immigration, okay, if we deport a whole bunch of people, right, that shouldn't be here in the first place. If we reduce the size of government and we say we get rid of even, 10% of the people employed by the government today, that's a whole lot of people back in the workforce looking for jobs, isn't it? Yeah. I'm sure U.S. companies could use a lot of those people that are in the government right now, sucking up government checks on the back of the taxpayer. I think if my belief, I think, and I'll say this plainly, I think you could cut the government in half. I think you could get rid of half the people in the government tomorrow, and I don't think anybody would even notice. I really don't. I think the government is so inefficiently run. There's so much waste and abuse and fraud in government spending in the budgets. And I would point to you. Let's talk about the FDIC for a minute. The FDIC. I get into this let's see here. The FDIC's board of directors approved the agency's 2025 operating budget. Apart from reduced salary and benefit increases, apart from scheduled salary and benefit increases, I almost got that wrong for a second. The largest component of the budget increase is resources to implement the action plan for safe, fair, and inclusive work environment. The board approved an operating budget of $3 billion. Let me say that again. The operating budget for the FDIC is $3 billion, a 2.2% increase from the previous year. Why does the FDIC need $3 billion? You know, the number of banks that they oversee goes down every single year, but yet somehow they just continue to need more and more. But what are all the people doing over there? What are they doing over there? You know, the FDIC, I hate to break it to them, but as far as them preventing, banking crises or banking disasters, they're always a day late and a dollar short. The FDIC is the janitorial crew. They're the guys that show up to mop everything up after it's already blown up. They don't stop anything. They don't prevent anything. Yes, they do. They do. I will give them I think they do a pretty decent job of going in, reviewing a lot of banks every year and checking things out. But they like to do a lot. They want to do more and more of that work remotely. You know, you basically give them access to your information. The bank sends information over to them. It's not like it was even 10 years ago when the FDIC would send a whole crew of people to your bank for 2 weeks and camp out in a conference room and go through all your loans and look at all your operations, your procedures, everything else, and then come back to you and say, oh yeah, okay, you know, we did our annual audit and everything's cool. You're all good now. It's all fine. They don't even do that anymore. Like everything's done remotely. And then maybe they might send 1 or 2 people down to have a conversation with you after the fact, to have kind of a little powwow get together, wrap it up at the end. So I asked the question, I'm just asking the question here. Why do they need a $3 billion budget? Why does the FDIC need $3 billion? You're telling me you couldn't shave $1 billion out of that? I think you could. I'm just saying, I think you could. So, the Fed has now let's look at this for a second. The Fed has lowered rates again. Does that mean 2025 mortgage rates will fall? Interesting. The Federal Reserve on Wednesday announced its 3rd consecutive rate cut, lowering its benchmark interest rate another 1/4 point. But the Fed's rate is just one in a tangle of factors that move mortgage prices. In fact, the two can even move in opposite directions, and it's happening right now. Really? They're just now feeling the need to explain this to people as people are waking up going, wait a minute, I don't understand. The Fed's reducing rates, but the mortgage rate's going up. What's going on? Ahead of the Fed's September rate cut, 30-year mortgage rates fell to a 2-year low. Yet 3 rate cuts later, mortgage rates have surged more than a full point higher. Oh, really? The upward push is driven by the Fed indicating that it now expects interest rates to remain higher in 2025 than originally projected, forecasting only a 0.5 point reduction next year instead of a full point. A slower, more gradual path downward for the federal funds rate could mean the 2025 mortgage rates improve less than initially anticipated. And they talked here a web of factors that determine mortgage rates. Not really. It's the 10-year. The Fed has been cutting rates, yet mortgage rates are surging. The Federal Reserve raised its benchmark interest rate to a 23-year high in July of 2023, following a historic rate hike campaign in 22 and 23 that targeted post-pandemic inflation. After maintaining the Fed funds rate at that elevated level for 14 months, the central bank finally began bringing it down in September. At the same time, however, 30-year mortgage rates have moved in the opposite direction. Although the flagship mortgage rate average sank to a 2-year low on September 17th, dropping as far as 5.89% the day before the Fed's first rate cut took effect, it has surged much of the time since. In fact, Thursday's 6.98% mortgage average is almost 1.1 percentage points higher than at the time of the Fed's first rate cut on September 18th. So we can see here on this chart, 30-year mortgage rate average since September of 2024. So you see here the initial rate cut here, and what, we've gone up, 6.57, surged up to 6.93, dropped a little bit, 6.75, then dropped down a little bit to 6.53, but is now surged back up to 6.98%. So what gives? As we mentioned, the Fed funds is just one of the many components influencing mortgage rates. What we learned on Wednesday was not just that the Fed was cutting rates a quarter point that was widely expected and already backed into bond traders and lenders pricing. More consequential to mortgage rates this week is the Fed's future rate outlook. So like I said, but they don't get in here to all the things that I just explained to you over the last half hour or so with the national debt, with what Janet Yellen was doing at the Treasury, with bonds and how bonds, the Treasury mortgage bonds and Treasury rates are going to continue to go up. And I think that, this is the band that you're going to be lucky to stay in here or like I said, at least in the short term, over the next 6 months, the next 7 months, you're going to be stuck in this probably 6.5% to 7% range. That would be my guess. But again, people are just now waking up to this fact that it's like, yes, we have not seen the kind of the federal funds rate and the Treasury rates moving, inverse of each other. We go in the opposite direction. We have not seen that in quite a long time, but it can happen. It has happened in the past and it's happening now. But people need to understand the real reasons for it. Why that's the real question, the why. Why is this happening now? And of course, this article, all it says is, oh, well, there's a number of factors that influence it. It doesn't really give you any real answers. I gave you the real answers. I told you what was really up. So, okay. Before I get into the next thing, which is going to be open banking, I want to go back to our good friend, Janet Yellen, for just a minute here. So, Janet Yellen's final comments here. And we're so blessed that she gave us these final comments this week. It's such a, while acknowledging that the current oversight system for U.S. banks is not perfect, U.S. Treasury Secretary Janet Yellen warned the incoming Trump administration against making radical changes that could disrupt essential oversight or the existing system that ensures bank deposits, because they've done such a bang-up job. In an interview with the media outlet, Yellen emphasized the importance of maintaining the safeguards due to the long history of bank failures leading to financial crises. How many banks failed over Trump's 4 years? I don't think any banks failed. And how many banks failed over Yellen's time? Oh, that's right. She had the 3 of the 4 largest bank failures in the history of the United States. Interesting. And then she goes on to say that basically she wished she could have done more in regards of national debt. On her way out the door, she wishes that she could have done more. But she recognizes now that the national debt is a major issue and we really need to get on top of that. It's so nice of Janet to share this information with us as she's walking out the door. As everybody knows, I don't like Janet Yellen. I can't stand Janet Yellen. I think Janet Yellen has become a political hack over the last 4 years. You can see the fact that she sold herself before the 2020 election. She basically took in $7 million in speaker fees from all of her buddies on Wall Street because she was coming in and told them all that she was going to be the next Treasury Secretary. So they were, of course, currying favor. But of course she denied many times that, you mean that's $7 million in speaker fees? Oh, that was nothing. I was just hanging out with my buddies on Wall Street. It didn't mean anything. Right. Her comments are just unbelievable and basically outrageous at this point. So unbelievable. Okay, so before I get into the other topics here, before I kind of run through the slew of other things, I do want to talk about what do we have. I want to pop out of this for just a second. I want to talk about what do we have coming up this week. What economic indicators do we have coming out? Because we do have a few. Even though we've got Christmas on Wednesday, it's a slower week because of the holiday, but we do still have a couple things coming out. So on Monday, we get the 2-year Treasury note auction. On Tuesday, on Christmas Eve, we get the building permits. We get the durable goods orders, new home sales for November, 5-year Treasury note auction, and then the API weekly crude oil stock. On Thursday, we get continuing jobless claims, we get initial jobless claims, and we get the 7-year Treasury note auction. And then on Friday, we get the goods trade balance and the U.S. Baker Hughes oil count. So not really a ton of economic data coming up next week, but we got, like I said, the Treasury auctions will be interesting to watch. Obviously, building permits, new home sales, some real estate data, and then continuing jobless claims and initial jobless claims. So a little bit of labor market employment or labor market data and information that we'll get, coming up next week, which will be good. And then, okay, so now let me turn to, I just want to take a quick second and go over the episodes and things that I had that came out over this last week. So Monday through Friday. So on Monday, I did episode 277, which was, Is AI Risk Keeping Board Members Up at Night? I thought that was a very interesting episode because, we talk so much about AI and the effect that it's going to have on employees and employers, but we don't really talk about it much from the board members' perspective. So I thought it was really interesting just getting some perspective from board members, like how they felt about AI, how they felt what was it going to do to their business? What are kind of some of the pros or cons that they're seeing at the moment? So I thought it was an interesting episode. On Tuesday, I did episode 278, which was RIP Bernard Marcus or Bernie Marcus, who was the co-founder of Home Depot. As I have done for a couple other people throughout the year, people who are monumental to the world of business, the world of finance, the world of economics, the world of banking. I like to pay homage to these individuals that do great things. And obviously, he built Home Depot into this giant. He changed the whole do-it-yourself homeowners economy. He changed how investors do things, how contractors do things. Home Depot it changed a lot. It changed a lot in this country. And like I said, he brought it to fruition, and the story of how he did that, I think, is a great story. So then on Wednesday, I did episode 279, which was Student Borrowers Have Problems. And I reviewed 2 new reports that just came out from the CFPB, the Consumer Financial Protection Bureau. And one of them was basically on the student loan servicers. So this, student loan servicers that service all the student loans themselves, and basically what was going on with them, what were their issues. And then the other report was basically what are student borrowers currently dealing with at the moment. So we kind of looked at both sides of the equation there. And I thought some interesting information that came out of both of those reports. On Thursday, I did the next installment, episode 13 in the crypto series, which was called The Trump Effect on Crypto. In that, I basically looked at, Bitcoin has exploded up to $100,000. We looked at a little bit of the history in Bitcoin and some of the price movements, how Bitcoin has kind of moved up and down. The title there, The Trump Effect on Crypto, is a little bit of a misnomer because I don't think it was a little bit about, obviously Trump is being very pro cryptocurrency at the moment, which is kind of giving a boost to the market. But we basically did kind of a really, I would say 90% of the episode was really based more on just looking at Bitcoin, looking at its price movements, looking at some of the things that have happened over the last couple of years, and just, getting into the nitty gritty, if you will, on Bitcoin, so to speak. So, and then on Friday, episode 281 is Fair Isaac's competitive advantage in trouble. And we kind of looked at, how Fair Isaac is basically a data broker that basically does the FICO score for all your credit reports. We looked into all that. So that was from 2 weeks ago. This week, we did episode 282, which was, Do People Use Safe Deposit Boxes? I saw a very interesting article in the Wall Street Journal on how the use of safe deposit boxes has actually been dropping in banks, and how a lot of banks opening up, kind of new branches or newer styled branches are not really providing safe deposit boxes to their customers. And what, so how does that affect the customer? There are customers that still use safe deposit boxes, and that is their main product. If you pull the safe deposit box from them, they're going to pull all their other accounts with it. So I think there's a lot there for banks to at least examine or look at or take into consideration. The next episode there, episode 283, which on Tuesday was, Should We Give Up Checks? And again, another article from the Wall Street Journal, basically examining check fraud and the use of checks, and how even though the use of overall checks has declined, we're still using billions of checks every year, and checks are still a great payment channel. Still a very easy way to make payments to customers and vendors and pay bills, pay taxes, whatever else have you, make charitable donations. Checks are still a great tool and they're still used by many people. It's just that check fraud for banks has been exploding, and it's been very difficult for them to deal with. So we kind of talk about that in that episode. Episode 284, government payments are the fastest growing source of income. So there I looked at an article from the Epoch Times, and I thought it was a really interesting article. It basically talked about how, people's dependence on the government every year is just getting to be more and more and more. It's now become the fastest growing source of income is the government check. So again, really interesting article, really interesting information there. I would, definitely recommend people go check that out when they have a second. On Thursday, I did episode 285, which was how can banks maximize their branch network? So again, this was an article from Bank Director, and it really looked at, the bank's branch network is so important to the value of the bank. I mean, the branch really adds to the franchise value of any bank. And this kind of notion that the bank branch is dead, the bank branch is on the way out, the bank branch has fallen by the wayside. I've been hearing that the almost 25 years that I've been in banking, I've been hearing that every year, that this is the year that the branch dies. And no, I have news for people. The bank branch is not going anywhere. The bank branch will be there. It's going to be there for a long, long time to come. It's not disappearing. And I could go into a whole tirade as to why that is or isn't, but, check out that episode when you have a minute. And then finally on Friday, yesterday, I did episode 286, which was how can banks better manage liquidity? This again was based on an article from Bank Director. And it looked at, basically the funding side of the equation, the balance or the deposits on the bank's balance sheet, on the liability side of the equation. Obviously, banks have had to pay up a lot more money, but there's been a number of factors or different things that have played out that have caused, banks, their funding mix, the cost of funds, all this stuff has really been dramatically shifted here in just the last 2 or 3 years. And there's been a number of factors, as we all know, the pandemic, government subsidies, the government pumping money, dramatic amounts of money into the economy in 2021, which caused the inflation that the Fed has been dealing with ever since. And so we kind of just talk about strategy, if you will, for banks. What are they going to do on the liquidity side of the equation? How are they going to fund the loan growth? All that. So if you're interested in seeing a little bit more of that, check out that episode. So, and then finally on the episode thing this week coming up, because it is Christmas week with Christmas on Wednesday. I do have a somewhat interesting week planned. I'm gonna start off on Monday, Tuesday, and Wednesday. I'm basically we're gonna be looking at numbers and information, but we're going to be looking at it a little bit more from a spiritual construct, if you will. How does your spiritual beliefs play into how you handle money, how you manage money? What do you do with money? What are your belief system and your values around money? And we're going to delve into that a little bit. On Monday, I'm going to be doing a book review of a book called The Wealthy Gardener, which I think a lot of people will find very interesting. On Tuesday, I'm going to be doing a report. I'm going to be covering on, if anybody remembers, if anybody was watching back when I did the Easter special, I basically talked about, I recommended a number of different books there that I thought were great for basically money management, personal financial management, that kind of thing. One of the things I recommended was a seminar called the Financial Freedom Seminar, which was written and performed by a gentleman named Jim Sammons. And this goes back many, many years. I think he first originally wrote the seminar, I think it was back in 1983. So it goes back almost 40 years. So, but I'm going to cover one of the chapters in that, and I think people will find that very interesting. Basically, recognizing false financial concepts. So, And then, like I said, and then on Wednesday, I'm going to do something very different because Wednesday is Christmas. I'm not really going to focus so much on banking. That episode is going to be a little bit different. I hope people like it, but like I said, I wanted to do something special for the Christmas holiday, so I'm going to do something a little special with that. Thursday and Friday, I'm going to get back to basics a little bit more. I'm going to be reviewing some blog posts from PCBB on Thursday and Friday. One of them is going to be kind of a year in review for 2024 on Thursday. And then on Friday is going to be kind of like, what are the bigger things coming ahead for 2025? So those are the things I'll be covering there on Thursday and Friday. And then the week after New Year's week, I have kind of a couple different things planned for that week. And I will say, I have coming into the new year, I have a boatload of reports to go through. I think I have 15 banking reports that have come out here in the last 2 weeks or so that I have to cover. And I think there's a tremendous amount of incredible information in all those bank reports that I have to get to. And just and like I said, I can go in all that, whatever, but I'll get that. I want to get back to some of the other articles here before we get out of here tonight. So, but that's kind of the update on that. And then also, I'll just say this too: in January, keep an eye out for. I'm going to be going into the financial history series that will be premiering. I was thinking about doing it over Thanksgiving, but then I decided to tweak it, kind of make some changes to it. So I'm going to go back to that. And that'll be coming out probably toward the end of January. So keep an eye out for that. Like I said, toward the end of January. So now let's get back into some of the articles here. I want to go into open banking here for a second. Obviously, we had the huge victory with beneficial ownership information. If everybody remembers that from last week, I talked about it, how basically the judge blocked that. But now we have to keep an eye this week because the FFIEC, they did appeal the judge's decision, and the judge was basically supposed to make a kind of a very quick ruling here that I think is going to come out by the 27th. So we have to keep an eye out for that. There's a chance. I don't think it'll happen, but there is a chance that the judge could overrule this decision by the judge, and this stuff could all get put into effect, and we could all still have to comply by January 1st. And so we'll have to keep a close eye on that. But here's the other big thing that's coming in here, and that is open banking. And so few people understand what's going on here with this open banking. But hold on, I need to take a drink here before we get into this. So this is called What the CFPB's Rule Means for Consumer Data and Competition. Even if your institution isn't required to comply with the new Personal Financial Data Rights Rule, preparing for open banking is essential. As consumer demand for data sharing grows, really, there's all this demand out there. Consumers are just dying to share their data with anybody and everybody, right? Adopting secure digital interfaces will help you stay competitive and meet evolving expectations. This whole thing really has me upset, and I'll read this to you here, friends. So in October, the Consumer Financial Protection Bureau finalized the Personal Financial Data Rights Rule per Section 1033 of the Dodd-Frank Act. This rule will enable willing individuals to share their financial data with third parties, including fintech apps, via a secure digital interface implemented by their financial provider at no charge. At no charge. That's a key thing, at no charge. In doing so, it fosters open banking principles by promoting data portability and consumer control and encouraging greater competition and innovation in financial services. Such data includes the following customer information: credit card and checking account numbers, prepaid and digital wallet accounts, 24-month transaction histories, terms and conditions such as fees, APY, credit limit, rewards program terms, etc. I don't know about you guys. I don't want to share that information with anybody. It's amazing to me. I don't want to share that information with anybody. Here's the thing with this. I don't like when regulatory agencies do this. This is why we just had the Chevron doctrine in the Supreme Court this year. They basically, Chevron doctrine changed their name of the game. Okay, in the past, if the CFPB comes out with this rule, they implement this rule, and that's it. We there's nothing we can really do about it, because they've got all the power. They can implement these rules. They basically they basically take the place of Congress, right? They're just writing these laws and putting them out there. Problem is, these aren't laws, and they're not Congress. They're a regulatory agency. They're supposed to enforce the laws enacted by Congress. Congress is supposed to tell them what to do and how to do it. But that's not what happens. Congress passes a law, and then these guys, the regular, not just the CFP, but any regulator out there, they take the law and then they interpret it as they see fit. And then they pass things that how they want to, they implement the rules and guidelines how they want to do it, which is absolutely ridiculous. And before, people couldn't do anything about it, but now we have the Chevron, what's called Chevron deference, and now these guys can get sued. And I would be absolutely 100% certain that these guys are going to get sued over this, because there's no law here. There's no law here. Congress didn't pass any law. Nobody told these guys to do this. These guys, the CFPB, went out and they did this on their own accord and basically just said, we're going to do this. And then one of my favorite things in this process is, so they will issue a rule, and then they'll say, oh, we're going to put out a comments period, right? So they put the comments period out there. And then during the comments period, people will put all these comments out there, tens of thousands of comments. Most of them will be negative and say, no, nobody wants this. Nobody's asking for it. Nobody wants to do this. And yet it's almost a moot point, because they're not going to, they put the comments out there so they can say, oh, well, hey, we asked for people's input, and people gave us their input, and we took it into consideration, but we decided that this was still the best course of action. In other words, they don't care what people say. They could care less of what anybody has to say. This is their goal. This is their prerogative, and this is what they're going to force on us. But this one is horrible. It's horrible because nobody was asking for this. I love how they sit there and say, oh, all these consumers out there, they want control over their data, and they want this, and they want to share their data with the companies that they want to share it with. Like, no. Yes, would people like more control over their data? Yes, but not like this. Not like this. And this is not going to protect let me be very, very clear. This is not going to protect your data. This is going to give companies like Google, Amazon, Facebook, who do you think is going to buy the data? Who's going to line up to take the data? It's going to be all of your big, huge tech companies. Why do you think they want that data? Part of it is they want to sell you stuff. Okay. And the other part of it is they want it for AI. They want to have AI examine all your stuff. They want to feed the beast. They want to feed everything. There's also this thing with the government. So the government, the government would not, and let me ask you this, like, could Congress go and pass a law basically saying that we want to collect all of your financial information? No, you can't, because that is what's called an invasion of privacy. It's in the Constitution. It's in the Bill of Rights. It's one of the amendments. You can't do that. The government has no right to all of your personal financial information unless they have suspected you of a crime. They've opened up an investigation. They have gotten a warrant, and they went down to the bank and said, hey, here's our warrant. We want to see their records. Then, yes, of course, the bank has to turn the information over to them. But outside of that, the government doesn't have any right to know what it is that you're doing or how you're doing it. But if this information is now, let's say Google gets all this information or Amazon gets all this information. Well, what's to stop the government from just showing up and just paying some money and saying, hey, here's some money. I want to buy that data from you. And then Amazon goes, hey, no problem. Hey, sure. Yeah, no problem. Here you go. You want to pay me $100 million? Yeah, I'll give you all that. I'll give you all that information I siphoned off for nothing for nothing. What does it say here? Provided at no charge. So now let's wrap up the consumer part of this for a second. So on the consumer part of this, they're going to say you're going to have more control over your data and that you can choose who you share your data with. Neither of those things are going to be true. You're not going to have control over your data, and you're not going to be able to choose who you share this with. They're going to give you some kind of BS opt-out thing, which is not really going to be an opt-out thing. You're going to be opt-into this the minute it goes through. Why would they be forcing banks to do this? Why would they be forcing them to spend all the money to do this if they weren't going to force people to release their data effectively? So that's the consumer side of this. Then where's the banking side of this? On the banking side of this, banks are going to have to pay. This is going to cost banks millions of dollars to build this interface. Then they're going to have new vendors that they're going to have to work with on this thing. They're going to have to sign new vendor contracts. That's going to cost them a huge amount of money. They're going to have to get much more cybersecurity because they want to connect this through APIs. APIs are notoriously bad. Okay, they're not secure. Okay, APIs can get broken into. It's been proven. Grid hackers can get into APIs. So if these things get hacked and the bank loses a huge amount of all their customer data, what happens to the bank at that point? They're going to get crushed. They're going to get crushed. And the kick in the butt is that they're not allowed to charge anything for this. They're going to have to spend all this money to build this portal, contract with these vendors, get additional cybersecurity insurance, all this stuff they're going to have to do. Not to mention the fact they may need to hire people that can handle this stuff. Okay, so you're going to have all that going on. And in the meantime, banks can't charge for it. There's zero profit motive for them to do this. So why in the world would banks do this? Like this is gonna give them a tremendous amount of liability and zero upside. So this is bad for the consumer. It's bad for banks. It's bad for everybody all the way around, and it's just mind-boggling. But let's take a look here for a second. So how will it be implemented? So they're proposing to implement this in stages, where basically it would start by April 1st of 2026, and they're going to have a couple of tiers where it's like, if you've got less than 850 million in assets, you're going to be exempt. But if you're over, like I think it's like 850 million to I think maybe like 1.5 billion or something like that, you'll have to do a certain amount, if you're over 1.5 billion, then if you're over 10 billion. So there's a couple tiers to it. And it basically says here, but banking experts urge community financial institutions, CFIs, to still consider implementing such an interface because customers might start to demand it. Oh, yeah. Particularly younger, more digitally savvy customers. If CFIs don't oblige, they may become less competitive in the marketplace. Experts contend. Yeah, okay. But there's a flip side. CFIs that implement these digital interfaces and craft targeted marketing campaigns can also be on the receiving end of valuable data from other institutions, digitally only banks, fintechs, and digital wallet providers. And CFIs can then counter with their own competitive offers. Oh, this is amazing. I love it. While banking associations last month filed a lawsuit, there you go, to set aside the rule, experts say that financial institutions should nevertheless take steps now to allow willing customers to share their data via open banking. There may well come a time when the market demands it, and early adopters may reap the most benefits. And then it goes on to say how to prepare. Work with your core data processor, data aggregator, or other trusted vendors. That's the additional vendors I was talking about. Focus on your customer experience. Mitigate for potential fraud. That's all the extra cybersecurity and everything I was talking about. Encourage both existing customers and prospective customers to share outside data with you. Really? So yeah, I just, like I said, I am a hard no on this. I hope the CFP gets sued into oblivion on this one. The open banking is one of the stupidest things I have ever seen proposed as a regulation. And I am so thankful for what the Supreme Court did by giving us the Chevron case, giving us the Chevron deference. That's the game changer. Because now all these regulators, when they try to pretend like they're Congress, because again, like I said, this is not a law. Congress did not pass a law. This is so they don't have. It's not a law they're trying to turn. This is a rule that they enacted. The CFP enacted on their own, of their own accord, that they put out there, and now they're trying to shove down everybody's throat. And it's ridiculous. It's absurd. I'm tired of regulators doing this, and now it's time. Let the lawsuits fly, because once they start losing these things in court, they're going to stop doing this, because it's because they're going to know that the minute they do something like this, they're going to get sued, and they're going to go to court, and they're going to lose in court. So it will begin to restrain these regulators, and it will basically put them back into a box where they basically sit there and say, you know what, we're going to have to, if we want something, we're going to have to go back to Congress and wait for it. Congress is actually going to have to do their job. Oh my gosh, I can't believe it. Congress might actually have to do their freaking job. It's amazing. So anyway, all right, that's my whole rant on open banking. But again, this is just like the beneficial ownership information. Nobody knows about this stuff. Nobody knows about it. Hopefully, if you're watching this, you're learning something about this stuff. I mean, that's kind of the whole point of why I'm doing this podcast, is to try to bring some of this information to people, so that hopefully people can learn about this stuff and understand it, and understand why they don't want it. But again, I don't know. I hope I'm making some tiny little difference out there. I really do hope I am. So anyway, all right, let's run on to some other things here. U.S. healthcare costs up 143% from 25 years ago. Experts say the increase in healthcare costs is due to a combination of hospital consolidations, growing prescription drug prices, and an aging population. And this little thing called Obamacare didn't help with that. That went into the the Obamacare helped that to go into the toilet, amazingly into the toilet. But like I said, healthcare costs are up dramatically. No shock there. This article was really interesting. Drugs young bankers use to get through the day and the night. Many on Wall Street use Adderall and Vyvanse. Am I saying that right? Vyvanse, as tools to plow through long hours of tedious work amid high pressure competition. Basically, and they go on the article to say how they're using these drugs. They're working 90-hour work weeks as an investment banker, an intern at Credit Suisse, that kind of thing. And they basically get addicted to these drugs after a few years. It's really interesting. And you had a couple of younger bankers this year that basically passed away. And, some people said it had to do with maybe the hours that they were working and different things that were going on. Maybe they were using different drugs. Maybe it was other things. We don't know. But there's kind of been an emphasis on this now with, the hours, the drug addiction, other things that are going on. But I don't know. I mean, I guess I have mixed feelings about this, because I kind of I look at it kind of like the NFL, right? Like, think about it. Like, people would say, well, if you go and you play in the NFL, you could get CTE. You could end up with brain damage. You could end up, you could hurt your back, your spinal cord. You could break your arms, legs. You could end up really messed up from playing in the NFL, right? But why do people do it? And why do they continue to risk their bodies? Well, because they're going to make a stupid amount of money. They're going to get paid a stupid amount of money. Why do people go up and work these jobs on Wall Street? Why do they go work these investment banking jobs? Why do they work for Goldman Sachs? Why do they work for JP Morgan, Credit Suisse, UBS? Why do they go work for all these big major banks? And why do they put up with these 90-hour work weeks? They do it because they're going to make a ton of money. It's in a certain respect, it's like the same thing. Like, most of these guys, and again, they're not, it's just like the NFL. Like, you're not going to do this job for 30, 40 years. You're going to work as a stock trader, stockbroker, investment banker, hedge fund manager. Like, you're going to do that job for probably, 10, 15 years, and that's going to be it. You're going to call it a day, and then maybe you might go start your own hedge fund, or maybe you might go become a financial advisor, or you're going to go do something else that's a lot less stress, that you don't make as much money, but it's a whole lot less stressful. But you're not going to need to make a whole lot of money, because you're going to be worth a ton of money, because you're going to make millions of dollars toward, maybe not your first couple of years, but I guarantee you within 10 years, you'll probably be making, a couple $1 million a year. working up there at Goldman Sachs. So, and if you can move up and make like partner or something like that, you're going to be, you're going to be making a boatload of money. And that's why people do it. So, so again, I'm like, hey man, if you're ambitious enough, if you want to go do it and you want to go put in the time and make that money, then hey, all the power to you. All the power to you. But again, it's the same thing with an NFL player. I would say the same thing. Hey, if you want to go play in the NFL and you want to take the risk of dramatically injuring yourself, okay, that's your choice, man. That's your choice. Go at it. But I do think, that being said, I do think that there is a conversation for, what are you kind of doing to these people if they end up drug addicts at the end of the day because of the way you're working them? Well, maybe there's a problem in how you're working them. Maybe you do need to take a step back and say, hey, what's going on here? If we got people dropping dead, we got people addicted to drugs, we got people with all kinds of problems. What are you doing there? So anyway, we'll continue to keep an eye on that one. CFPB sues JP Morgan Chase, Bank of America, and Wells Fargo over Zelle payment fraud. So anybody out there that has Zelle, you have the Zelle app. There's been a lot of payment fraud on the Zelle app the last year or so, and now the Consumer Financial Protection Bureau is suing these big banks because they own Zelle, and they haven't really been doing a whole lot about the fraud. CFPB, Financial Protection Bureau, on Friday sued the operator of the Zelle payment network and the 3 U.S. banks that dominate transactions on it. The agency alleges that the firms failed to properly investigate fraud complaints or give victims reimbursements. Zelle said in a statement Friday that it was prepared to defend itself against the meritless lawsuit. Yes, we shall see. I don't think it is meritless. But again, like, this is something the CFPB, as opposed to open banking, this is what the CFPB should be doing. If they see something like this, they should be that's them doing their job as a regulator. The open banking stuff, no. Anyway, so we'll keep an eye on this one. We'll see how this unfolds here. So, yes, Mr. Biden. So this might be a great way to end the night. So anybody who did not see this article yesterday, this was the much talked about and discussed article of the week in political circles, how the White House functioned with a diminished Biden in charge. Aides kept meetings short and controlled access. Top advisors acted as go-betweens, and public interactions became more scripted. The administration denied Biden has declined. This article basically spells it all out. I'm going to say it in a nutshell that basically Joe Biden was cognitively in decline for his entire presidency. He was cognitively in decline before he stepped into the White House. And the first day that he did step into the White House, he dramatically diminished thereafter. The press knew about this. His administration knew about this. They knew about this for 4 years. They lied about it. They covered it up. They didn't tell anybody. And this guy's still in the White House right now, today. We'll see if that lasts much longer. Maybe. See? I don't know. But why am I telling you this? And why am I looking? I mean, this is a show about banking. Why are we looking at this politics or whatever? This gets back to the heart of the question. I've had people ask me, I've ranted for, months and months and months now about the employment numbers, the GDP numbers, the inflation numbers, all being what I've claimed are all BS. They're all overstated, understated, misstated. There's a tremendous amount of garbage in there, mostly to try to make the, Biden administration look like it's not really doing that bad of a job. But here we come to find out that this man probably should have had the 25th Amendment against him, probably should have been impeached. And it just goes to show you how fake this White House was. And I would tell people, I would remind people, they literally built a fake White House across the street from the White House. They built a fake sound studio that looked like the White House, that looked like the Oval Office. And that's where they did everything from. Everything that Joe Biden did for 4 years was fake. It was totally fake. It was totally scripted. They didn't allow him to do press conferences. They didn't allow him to talk to the press. They totally shielded this man for 4 years. when people went in to meet with him. And there were 50 people cited in this article, 50 sources, not like one or two, 50. All people from the White House that all came forward and basically said, oh, yeah, this whole thing was a joke. When he would meet with people, they would tell the individual, okay, you've only got 2 minutes. They would give them a card and say, here's the question you can ask the president. And then they would give Joe Biden a card with the answer and say, this is all you could talk about with him. And that's how it went at the beginning. And then as it progressed, they basically just stopped having meetings. He stopped having meetings with his cabinet. These are people that the president needs to be meeting with every week. And he was meeting with them like twice a year. It's mind-boggling. And this is what gives credence to my entire argument about all of the economic numbers being BS, because this administration, this entire administration for 4 years has been BS. And I'm tired of being lied to. I'm tired of getting bad economic numbers that we're supposed to make financial decisions based off of those economic numbers. When the full economic calamity is known, and it's coming in the next few months, the next 4, 5, 6 months, it's all the carpet is going to get pulled up. The curtain is going to get pulled back. We're all going to see. Everybody's going to see what this absolute calamity that has been brought on us by this White House. And I think that when the full tragedy is known, this administration will go down as the worst administration in the history of the United States, bar none. Bar none. It's going to go down. This is the calamity to hear there, because everything was fake. Everything was fake. We had a fake president, fake White House, fake numbers, fake everything. And I'm just tired of it. And again, like I said, for the people that I've talked to that basically said, why do you think the numbers are fake? How do you think this? Why do you think all of this is nonsense? And this I give you right here. Boom. Right here. This is the press finally waking up after 4 years saying, yeah, you know what? It was all a charade. It was all a charade. It was all a lie. It was all BS. And here it is. So there you go. And then, of course, Biden continues to forgive student loans, even though the Supreme Court said that was illegal and he couldn't do that and he was breaking the law, but he doesn't care. He's doing it anyway. Home sales keep rising despite higher mortgage rates. So sales of existing homes rose for a third month in November, posting their biggest year-over-year acceleration since 2021. Despite the uptick, sales are on track to end the year at the lowest since 1995, thanks to high mortgage rates. The increase in sales suggests buyers are getting used to the idea of paying rates in the high 6% range compared to 3 or 4% before the pandemic. Yes, so we'll talk more about how this will unfold in 2025. We'll get more to that later. What else do we got here? We got home builders' hopes are rising, however, for 2025. Home builders' confidence in the future increased to its highest in nearly 3 years as builders cheered Donald Trump's election and anticipated relaxed regulations. Builder assessment of present conditions remains subdued as high prices and mortgage rates continue discouraging buyers. The outlook for mortgage rates next year has worsened. Economists now expect mortgage rates to stay above 6% through 2025. That's basically exactly what I told you earlier on. Auto sales drive unexpected boost in consumer spending in November. Kind of interesting. So U.S. retail sales increased by 0.7% in November, marking the sixth consecutive month. Sales data came in better than economists projected. A big jump in auto sales is behind the latest surge in retail activity, while e-commerce firms also reported strong gains. The retail sales data could complicate the Federal Reserve's thinking on its policy math. I don't think so. And then here, one little bright spot, FTX to begin repaying customers in early 2025. What you need to know. So former FTX customers with claims of $50,000 or less will begin receiving repayments in early 2025. An effective date for repayments has been set for January 3rd, 2025, and payments are to be made within 60 days of the effective date. While the bankruptcy plan has been touted as a solution that provides the vast majority of customers with 119% of their account values, the reality is users will have missed out on the massive gains in the crypto market since November of 2022. Crypto exchange Kraken and crypto custodian BitGo are set to assist with the bankruptcy distribution. So hopefully some good news there if you got wrapped up in FTX or any of the nonsense that happened with that. But with that, I will close out for the night. I want to thank everybody for joining me this evening. I wish everybody safe travels throughout the holiday season here. I want to wish everybody a very Merry Christmas, or, if you celebrate any other holidays out there or have any other religious followings, I hope you have happy holidays there. I am going to try to come back and do a live stream next weekend, but it's probably going to be on Sunday if I do it. I'm hoping I will be able to get, I'm doing some stuff on my own end here with the holidays. And so again, I won't be able to do the live stream on Saturday night next week, but I'm hoping to have it on Sunday. I will schedule it for Sunday and see if I can make that happen. So, but as always, I've told everybody I'm really trying to make a march to getting toward 1,000 subscribers. So if you really like what you're seeing here on the channel, please make sure to spread the word and try to get, like I said, the more goodwill and the more everyone is willing to spread, hopefully the good content that I'm putting out there will help immensely. But please, as always, make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to check out the content that I put up throughout the week. And like I said, be safe out there. Have a Merry Christmas. Have happy holidays. I wish everybody nothing but the best, and I hope to see everybody again real soon. Enjoy the rest of the weekend and the holiday week. See everybody next week.